Why do certain companies dominate their industries for decades, while others rise quickly and then disappear just as fast? Why do some businesses not only survive competition, but make competition almost irrelevant? The answer often comes down to one idea: category kings. These are the companies that don't just participate in an industry, they define it. They control the largest share of the market, set the standards competitors must follow, and benefit from structural advantages that become stronger over time. Because when a company becomes the leader in its field, growth doesn't just continue. It compounds. And that idea sits at the center of strategies like the Monopoly ETF, ticker MPLY, from Strategy Shares, which focuses on owning companies with dominant positions inside their industries rather than owning the entire market. Today, we're going to break down the case for owning category kings, why industry leaders tend to outperform, how economies of scale create long-term advantages, and why structural dominance can matter more than short-term growth. Number 4. Industry leaders don't just compete, they control. In almost every industry, dozens of companies try to grow at the same time. They launch new products, lower prices, advertise aggressively, and try to attract customers away from competitors. But over long periods, something interesting happens. Instead of the market staying evenly competitive, leadership usually concentrates. One or two companies begin to pull ahead, then they pull further ahead, and eventually, they become the default choice for customers. This happens because once a company becomes the leader in its category, its position starts reinforcing itself. Customers trust the leader more because it is already widely used. Partners prefer working with the leader because it has the largest reach. Suppliers give better terms to the leader because it buys in larger volumes. Investors give the leader cheaper access to capital because it looks safer and more stable. All of these advantages make it easier for the leader to keep growing while competitors struggle to keep up. Industry leaders don't just compete on equal terms. They start playing a different game. Instead of fighting for survival, they focus on expansion. Instead of protecting margins, they can invest in the future. Instead of reacting to competitors, they set the direction of the industry. This is why long-term market performance often becomes concentrated in a relatively small number of dominant companies. Leadership, once established, tends to persist. And for investors, persistence is what allows compounding to happen. Number 3. Economies of scale: why bigger often get stronger. One of the biggest reasons category kings stay dominant is economies of scale. Economies of scale mean that as a company grows larger, it can operate more efficiently than smaller competitors. Costs per unit decline, margins improve, and the company gains flexibility that others don't have. Large companies can produce goods at lower cost because they buy materials in massive quantities. They can build global supply chains that smaller firms cannot afford. They can invest in automation, technology, and infrastructure that only makes sense at large scale. This cost advantage creates a powerful feedback loop. Lower costs allow the company to offer better prices or higher quality. Better value attracts more customers. More customers increase scale. More scale lowers costs even further. At the same time, large companies can spend more on research and development without hurting profitability. They can experiment, innovate, and improve their products while still generating strong cash flow. Smaller competitors often don't have that luxury. They must choose between growth and profitability, while the category king can pursue both. Scale also creates resilience. During recessions, large companies often survive while weaker competitors disappear. During inflation, large companies can negotiate better supplier contracts. During industry changes, large companies have the resources to adapt. Over time, this means the biggest companies don't just stay big. They often become stronger. And that is one of the main reasons industry leaders tend to outperform over long periods. Number 2. Structural advantages create long-term dominance. Scale alone is powerful, but the strongest category kings usually have something more: structural advantages. Structural advantages are built into the business itself. They are not temporary. They don't disappear because a competitor wants to grow faster. These advantages can take many forms. Some companies benefit from network effects, where the product becomes more valuable as more people use it. Once a network becomes large enough, it becomes extremely difficult for competitors to replace. Some companies benefit from strong brands that customers trust automatically. Brand loyalty reduces price sensitivity and protects margins. Some companies benefit from switching costs. Customers stay because changing providers would be expensive, risky, or inconvenient. Some companies have regulatory approvals, patents, or licenses that competitors cannot easily obtain. Others have proprietary technology or data built over many years. Investors often describe these advantages as moats. The term was popularized by Warren Buffett, who compared great businesses to castles protected by wide moats that keep competitors away. A strong moat means the company doesn't need to win every battle. Its position is protected. And when a business has both scale and a moat, its dominance can last far longer than most people expect. That durability is what makes category kings so valuable for long-term investors. Number 2. Why leaders often widen the gap over time. Many people assume that competition eventually eliminates dominance. But in reality, the opposite often happens. Leaders frequently widen the gap. Once a company becomes the category king, several advantages begin working together. It has the most customers, which means the most data. More data improves the product. A better product attracts more customers. More customers increase revenue. More revenue funds innovation, marketing, and expansion. This creates a cycle where the leader keeps getting stronger. Meanwhile, competitors are trying to grow with fewer resources, smaller budgets, and less market share. They spend heavily just to keep up, while the leader invests to stay ahead. This dynamic explains why many industries become more concentrated over time instead of more competitive. Dominance attracts more dominance. And over long periods, the gap between the leader and the rest of the field often becomes very large. For investors, this matters because companies with widening advantages tend to produce more consistent long-term returns. Number 1. What this means for investors. This leads to an important question. Should you own the entire market or focus on the leaders? Traditional index funds own everything. They hold the strongest companies, the average companies, and the weakest ones. This approach provides diversification and simplicity, but it does not distinguish between businesses with durable advantages and those without. A strategy focused on category kings takes a different approach. Instead of owning all companies, it looks for those with dominant positions, strong market share, pricing power, and structural advantages. The idea is not to predict short-term winners. It is to own companies that already show the characteristics of long-term leadership. That philosophy is reflected in the Monopoly ETF, ticker MPLY, from Strategy Shares, which focuses on companies that demonstrate strong competitive positioning within their industries. Rather than following the entire market, the strategy emphasizes structural strength, durability, and dominance. For long-term investors, that difference can matter more than short-term performance. Category kings don't just grow, they compound. Industry leadership creates scale. Reinvestment strengthens the moat, and the cycle repeats. This is how dominant companies stay dominant. The Monopoly ETF, MPLY, is built around the idea that these structural advantages drive long-term returns. Not hype, not speculation, not short-term trends. Just a simple thesis. Companies that control their categories often control their future, and owning those companies systematically may be one of the most disciplined ways to think about long-term investing. If you found this breakdown helpful, subscribe for more deep dives into serious investment strategies. And let me know in the comments, do you prefer broad index investing or focusing on category kings with real competitive advantages?